Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. The financial sector is full of powerful cash generating machines, and normally we don't look at that sector because everyone thinks there is full of companies that are not Sharia compliant. So what I would like to do today is share with you guys 7 companies that are in this financial sector that are all Sharia compliant, and some of them are undervalued at this point in time. So I'll give you everything you need to know about the companies. I'll give you some information about their intrinsic values at this point in time. And then, of course, as always, take it from there. Do your research, find out a bit more information about the companies. And yeah, let's see how it goes, inshallah. But before we move on, if you can press that like button, it doesn't cost you a penny. And that will be very helpful to the channel. That will be absolutely amazing. If you can join us at the Patreon account where you get access to a lot of things, inshallah, that will be also very helpful. So let's get started straight away. I want to make sure this video is not long. So let's get started with the 7 companies. And like I said, all of these companies are Sharia compliant. All of them are in the same sector. And the first one that we're going to talk about today is Mastercard. We always get this question about whether Mastercard is a Sharia compliant and how it is Sharia compliant. Same goes for Visa, which we will also talk about. And Mastercard is one of the world's largest payment networks, and their main job is to basically facilitate for the transaction between A to B. So if you're the buyer and the seller, between the buyer and the seller, that's basically more or less in a nutshell their job. And one thing I love about the company is every time basically, every time a transaction happens, Mastercard of course gets a cut of those transactions, and that's how they make their money. And of course companies are happy to pay. As you can see here, they've got wide moat. Is 495 billion market cap, right now trading $551 per share, dividend yield of 0.5, payout ratio 19%, which is very low. We normally tend to get companies that less than 60%, and the reason for that is because you want companies to grow that dividend. And 19%, if they're spending 19% of their net income to pay as a dividends, that's a massive chance for us to get, hopefully in the next 5 to 10 years. By the time this, every single year they probably will increase it, just like they've done over the last 5 years, 15%. The latest increase was 15%, and the last 5 years 15%, which is absolutely amazing. I promise you will not find a lot of companies like that. Dividend streak is 13 years, so they've increased this dividend for 13 years. You get $3 for every share of this company that you own. Safety 99%, that's the highest any company can get. Profit margin 45%. Return on equity 185%, and return on invested capital 53%. Normally we like to make sure these companies that we're investing in are profitable, and also management are doing great job and taking the money that they receive in the free cash flows and the money they get from us and so on, and reinvesting into the business to grow that business. So that's the return on invested capital. We want to make sure that on the profit margins, return on equities, all of these things are very important. On top of that, you got amazing free cash flow, $15.8 billion of free cash flow right now. EPS is expected to grow about 16%, revenue about 12%. Now if we see a market in the next few weeks a little bit of a volatility in the market, this will become a basically undervalued stock, because right now it's about 6% overvalued according to Morningstar valuation. If we look at, for example, fast graph is slightly different, and I just want to share with you guys historically where the company has been. So in 2012, 2013, from 2013 onwards, it basically is more or less been overvalued, and it's been like that for a very, very long time. Now if we look at the performance against the S&P 500 since 2006, you can see 28% total return, which is absolutely amazing against that S&P 500 of less than 10%, and they're growing that dividend massively as well. Now if we look at the forecast moving forward for this company, and you're using that 15 estimate for 16 for the next whatever years, right now if you use that 15 PE, this is not basically for this company. For the last 5 years, since I've basically started investing in this company, it has been trading around the 30s when it comes to the PE side of things. So 38 has been the average for the last 5 years. So if we use that right now, then you'll be making about your 10,000 will become about $15,400 US. And again, maybe slightly, even if you go lower slightly and basically go for, I don't know, what is that, 30 PE, for example, you'll still make about over $2,000 on top of money, about 23% on top of your money, which is quite nice to see. And if you look at the Mastercard on the Seeking Alpha, as you can see here, we've got 24 strong buys, 5 buys, 10 holds, and it's about 19% upside from where we are. The next company we're going to look at today is Visa, and I've already said this. Visa, Mastercard, they are more or less the same company, not much difference. The twins when it comes to the payment side of things. So another cash flow powerhouse with a massive global network, and yeah, they're doing an absolutely amazing job. Same thing more or less when it comes to overvaluation right now. In terms of profitability, they're very similar. That dividend very similar. Free cash flow over $22 billion. Now let's go here and check this out, and we'll go here as well and check how Visa is doing. So first we'll start with this one. As you can see, 25 strong buys, 6 buys, 8 holds, 1 sell, and it's about 17% upside from where we are. Looking here, if we look at historically, more or less the same since 2003. The company has been overvalued since then, according to this. I bought it, I think it was 2020, and since then basically I've been holding on to it, and it's been doing really well. And that basically blue line is basically the PE of 27 and so on. Now if we look at the performance against the S&P 500 over the last, since 2008, you can see about 19% against that 9% of the S&P 500, which is quite nice. On top of that, you've got the forecast moving forward. So that 12%, 13% ups when it comes to, if we look back here, you can see that 12%, 11% for revenue side of it. Here more or less about 13%. And if we use that for the, basically it's overvalued. But if we use the normal multiple, which is very similar to, again, Mastercard, so about 30 PE, basically the average was about 30 in the last 5 years. If we use that, you can see your 10,000 will become about 15,000. Even if we say we're basically maybe 20 PE or so on, or 24 PE, you still be making about at least 20% on top of your money. Another high quality business that not many people talk about is the S&P Global. So these two companies, in fact, I'm going to show you both of them because they're more or less similar again in terms of how their performance, in terms of things they do. S&P Global, is the most powerful most powerful information and analytics company in the world. It's now for the credit rating indices like the S&P 500 and so on. And when it comes to MSCI, is another elite data business. So it provides the indices, analytics, if you like, ESG ratings and so on. So very similar business in terms of that. But right now, both of them are undervalued according to Morningstar valuation. They have been, this one has basically become dividend king. So they have increased that dividend over 50 years. And the MSCI have basically been doing over the last 10 years. But they both have excellent dividends. Free cash flow, not bad at all. 5 billion, 1 billion. Again, when it comes to the growth side of it, next year, more or less similar. So very similar businesses. And if we look at the historically, the S&P Global first, you can see since 2013 is more or less been overvalued, and it's been basically closer to that blue line or slightly higher than the blue line. If we look at the performance against the S&P 500 since 2004, you can see it's beating the S&P 500, which is nice to see. The forecast, okay, right now if we're using that normal PE of 15, is of course it looks overvalued. And if we use the normal multiple for this one of 31, which is basically where it's been over the last whatever years, then we're looking at about 40% on top of your money, which is quite nice to see. If you look at Seeking Alpha, you can see about 17 strong buys, 6 buys, 1 hold. It's a strong buy right now, as you can see, 24%, 25% upside from where we are, which is really good. This is one of the companies that I potentially will be adding to in the next few weeks. I'll let you know, inshallah, how that goes. And looking at MSCI, as you can see, since 2014, it's also been overvalued. It's gone up a lot at one point. It came back down, and then it's gone up again a little bit. So as you can see, it's actually done well in terms of price wise. In terms of a lot of these companies have been overvalued only because they have of course higher multiples for a reason, because the returns are beating the S&P 500. So this one almost double of what the S&P has returned since 2007. Dividend growth has been absolutely amazing. If we look at the forecast moving forward, if we're using again that 15 PE is not acceptable for this type of business. Normal multiples, right now, if you bought this stock with that 45 almost PE for the average for the last 5 years, then you're looking about, your 10,000 will become 17,000 US dollars. But even if you say, you know what, maybe a more realistic thing is about 31 PE or so on, then in fact, let's just have a look at where it is right now. About 33 PE, which is basically, even if we use that, okay, so 33, let's go with 31, so on, then you will be making about 20% top of your money. So your 10,000 will become 12,000 by the time we get to 2027. Now, if we look at this, you've got 9 strong buys, you've got 5 buys, 3 holds and 1 sell, and 14% upside from where we are. So that's the next one. The next 3 are very much sort of companies that we haven't spoken much about, and the first one is Toast. And this one is a fast-growing fintech focused on restaurant payment systems and management software. So that's basically in a nutshell what they do. They have a narrow moat, 22 billion market cap, no dividends yet. Profitability is okay. Return on equity is decent. Return on invested capital is actually quite good. Over 500 million in terms of free cash flow side of things. And EPS expected to grow 20%, revenue about 20%, 4% up, basically overvalued at this point in time. With regards to fast graph, there's not much to talk about. The company is very much new, as you can see here, but they're expecting 20% growth. So in 2025, it basically is growing massively, 85%. Next year, 20%, 23% the year after. If we look at the performance side of things, it hasn't really done much since 2021. Basically, it's just return is very small. So we'll see. Like I said, it's a fast growing company. And if you look at the forecast, the normal estimate, so this 23 PE for this company, you're losing about 3-4%. If you use the normal multiple, where it's been over the last whatever years, then you'll be making triple your money almost. Wait, your 10,000 apparently will become 54,000 US dollars, which is absolutely ridiculous. Again, even if but it's 133 PE right now. What's the current PE for forward PE that I'm interested is 36. Let's look at the rest of the growth side of things. So we got this year, and then we got next year 2026, which is what I just used. 2027 there 27%, and then 15% after that, 20%, 18%, 14%. So we'll be interesting to see what happens to this company in the next few years. The next one is Jack Henry and Associates, another one that we've never actually spoken about. They work with banks, they work with credit unions, and they have sort of a recurring revenue business model. And basically they've got excellent dividends, which is quite interesting. So they would have become, if they were part of the S&P 500, they will have actually become a dividend aristocrat. 35 is increasing that dividend. Profitability, return on equity, return on invested capital side of things is really good. Free cash flow is decent for a company about $11 billion. They expected the earnings to grow about 6%, revenue about 5%, 19% upside from where we are. Again, another one that has been overvalued over the years since 2012-13 has been going up to the right, and actually has come down a little bit in basically this year. That's probably why it's a little bit undervalued. According to this, is actually a 19% upside from where we are. And as you can see here, that has got about 27 PE over the last whatever years. If we look at the performance against the S&P 500, you can see that it has beaten the S&P 500 since 2005, the total returns, which is really quite good for this type of business. And then you've got forecasting moving forward. So if we're using this, again, similar sort of situation, if we use the normal multiple, which is that 35 PE for this company, again, you will be making about closer to 7,000 US dollars by the time we get to June 2028. And the final company we're going to talk about today is FactSet, one of those companies that that came down a lot recently. Let's actually check FDS. Let me see how much is actually down, because I think if we look at the year to date, for example, 25%. Okay, Quant is actually saying a strong sell, which is quite interesting. So 25% to 45% down since the year, basically for the year to date. For the 1 year, 45. For the last 5 years, ooh, that's not great, 19%. And the last 10 years, only 53% up. The market cap is basically about just closer to $10 billion. There's another one that basically provides financial data analytics to basically small, similar to Bloomberg and Refinitiv, there's a lot of companies that use their web, basically data that they've collected. So if you want to build your own sort of a research, like this one here that we're using, basically you'll get some sort of a subscription model from this company. So they have recurring revenue. So they will provide the data for your websites and so on. And as you can see, if we look at the if we start with this 3%, so 3 people are saying a strong buy, 11 holds, and 1 sell, or 5 strong sales, which is interesting. A 29% upside from where we are, which is interesting. So overall, about 45% down this year, 26 years of increase in that dividend. Free cash flow is decent. Profitability side of things is okay. So it's probably got some, head when something is going on with the company. It will be interesting to see how it performs over the next couple of years. But let's have a look at what historically the company has done. Again, another similar situation since 2008. The company has been overvalued, but it's been between that blue line, which is basically that normal 26p if you like, and then since then it's actually down a lot. This is probably the first time since COVID it's actually been down that much, which is very interesting. It's touching that almost the orange line, which is nice to see. Now, performance wise, for the last whatever years, since 2005, it has actually beaten the S&P 500. And then moving forward, if you look at the forecast, if you bought this stock right now using that 15 PE, your 10,000 will become $12,270. So it's still undervalued even if we use that 15 PE. If we use the normal multiples, which is 30, so the double where we are, so that right now if you bought this stock, you'll be making you will have $24,000 by the time we get to 2028. So this is an interesting one. That's down a lot. So it'll be interesting to see why basically they think it's a strong sell. So let's see. We could potentially look into it. So they have been saying it's a sell or a strong sell for almost, since February of last year. So it'll be interesting to see, maybe do a little bit more digging if you're interested in that company. Again, just before I finish the video, let's have a look. If you haven't liked the video, by the way, please do so. It genuinely helps the channel. And of course, it doesn't cost you anything. Join us on the Patreon account if you can. From Shariah-compliant side of things, this information comes from Zoya, which uses these standards. And as you can see here, none of these businesses have any issues with regards to that. This can change, of course, that you need to keep an eye on those things. But like I've always said to you guys, I own all 4 of these companies, and I will show you very quickly. I do own Visa there. So just over $5,000, about 50% up since I bought it. I own S&P Global, another one that's about 30% up right now, or 1,400 closer. And then we've got Mastercard here, that's up about 13%. And then finally MSCI, which is up about 6.5% over the last whatever weeks, because it's been down a lot. I've tried to buy a little bit more. I think I own about 16 shares. So all of these companies are great companies that you could potentially buy today and hold them for a very, very long time, especially these 4 here. That they are my favorites. I like this one here. It's an interesting place, but the other 2 are very small. This will be a lot more riskier because of the size of it. Okay, not only the size is because of the fact that it's still growing company. It's growing really fast, but that could also mean is a lot more volatile. If earnings don't go well, then it's one of those companies that could potentially come down and so on. So yeah, that's overall what I want to share with you guys. If you enjoy this type of content, it takes a lot of time and effort to put these videos together, to plan it, record it, and edit it, and then post it for you guys. It takes genuinely a lot of time. So I will genuinely appreciate if you can press that like button. Have a wonderful day. Assalamu Alaikum.